Welcome to our investors presentation. For us, this is a bit of a stepping stone, because as a company we've always kept a very low profile, excepting in the case of our customers. We try to keep a high profile. And during the course of this year, we have decided to become far more aggressive, if you can call it, in terms of our relations with investors and financiers, etc. So hence the beginning of this investor presentation, which we hope is going to be one of very many to come. It also, I think, is going to be a medium in which we can discourse with our investor base and people who haven't invested. We can have a discourse with them as to what our company is, what it has done over the years, and what we hope to be doing in the future. There are a number of slides that we've got, and I'm not really very good at working on slides, so I'll do a combination of the two. This is the agenda for today. The first is the group at a glance and strategy, which I'm going to present. After that, Willie will present, that's Willie van Blyk, our FD, will present a financial overview. Lawrence will present the operational overview, as well as the prospects of the company. Before we actually look at the detail on that slide, and we won't go into too much, I just want to give you a bit of a history of the Workforce Group. It was started in 1972, which is quite a while ago, by myself. It was at a time when outsourcing wasn't heard of in South Africa. It was a medium that was used to employ mainly artisans and contractors in Europe and in America. And at the time that we started, our first contract was with AE&CI, which is now AECI, and it was for 12 boiler makers or 15 boiler makers, and they came from an assortment of Portugal, England, Germany. That's where South Africa was getting its artisan labour from. So that's where we started, and the company grew from strength to strength, and we diversified our interests, going away from artisans to various blue-collar workers to some white-collar workers, and we got a wealth of experience and stretch throughout South Africa. Hello, Charles.
Oh, yeah.
Came here.
Okay.
We got a wealth of experience in the industry. We grew up in it, or I grew up in it, and it enabled us to develop where we are today with systems development, recruitment experience, people management experience. These are things that they're part of us. They're part of what we do. The company then listed in 2006, which is a long life for companies that listed on the Altex in those years. We survived it. We went through some hard times, but we have also made enormous progress in what we have done. Our current structure of our business is represented on this slide. We have our current turnover for the 6 months, and I'm referring to over here, is about 904 million. We should be at 2 billion for the year. We have 60 branches nationally. We deploy about 32,000 staff on a daily basis. Our management and support staff are 1,000 people. From a BBE point of view, we are at a level 3. We pride ourselves in the fact that we serve all industries and manufacturing processes and all aspects of staffing. Our offering is an end-to-end offering, which we will show you further. It is not only the employment of the staff, it goes much further than that. It's the training of the staff, the recruitment, the management of the staff once they're on the site, their post-site management, their healthcare management, and various other aspects. When we do start with a client, we become their staff manager. From a point of view of compliance with legislation over the years, we have found invariably that when we take over a part of the client's staffing, that we rectify the non-compliance that exists within the client's business and bring it into a compliant basis. Our current structure in terms of this is understaffing. We've got various brands, Workforce Worldwide, which deals with staffing in other parts of the world, Teleresources, which is very focused on the call center industry, particularly on the call center industry, which has been started in business process outsourcing by the government in the Cape and in Natal. AllMed is our medical division, deals with nurses, both in hospitals, private homes, and the like. And then all of this falls under the workforce. In your recruitment side, recruitment as opposed to your staff outsourcing, your model is that you're the employer, you have the staff working at the client, and your fee is based on a percentage of what your employee is paid. Whereas in the recruitment business, it's finding a position for a person, making sure they're suitable, and your source of income is then a flat fee for that placement. It's a one-off fee, whereas in the staffing, it's a continuous fee. Our brands there are FemPower, which is a very old brand in the market and established brand. Acotech, which focuses on accounting and information technology, permanent placements. Only the Best, which is again an old brand in the market. Nursing Emergencies, and Jet Talent, which is a joint venture between us and a Jewish organization where basically we assist people who are not in positions. We try and locate positions for them. Our next stream of income comes from training and consulting through Training Force, and we do some consulting as well. We'll go into more detail on all of these. We'll go into more detail in the operational report that Lawrence gives. We have the financial and lifestyle products, which are essential employee benefits, Barbaric and Dreams Direct, employee health management, which is really the health management of employees that are on both our employees and clients' employees. And it works through Workforce Healthcare and DNA Services. I'll give what really happens there a bit later. And then we have our process outsourcing arm, which basically involves an outsource of the process as opposed to the outsource of the stock. So the charge basis is by unit produced as opposed to by hour of labor. So we then take on more risk because we are responsible for the production, and but our margin is a better margin than in the others. Okay. Our integrated value proposition involves aligning and integrating our diverse and independent businesses to create one solution for the client. So we try to incorporate all of these elements in what we do for the client. The growth drivers in our business are organic growth of our existing businesses. We have acquisitive growth, which we have done in a very small way in the past, which we're accelerating now. Product diversification. Within the staff outsourcing field, there's a huge range of products. You can outsource pilots from South African Airways and rent them out to the Israeli Airways. It happens. Okay? And there is a staff provider who sits in the middle of that transaction, organizes it, manages it, and does it. You can send fishermen from South Africa to Alaska to fillet fish, because our season, when we fillet fish, is at the exact opposite of the season when they fillet fish in Alaska. I'm just trying to show you the breadth of the industry. Approximately 4 years ago, the unions and the government started talking about banning of the labour broker, saying that this is something that is very evil and whatever they said. And the industry, unfortunately, didn't respond. They allowed the noise to happen. And it continued for about 4 years. A lot of debate, both at NEDLAC and at BUSA, as to whether you can ban the labour broker, which means banning temporary employment. It's not a labour broker, it's the temporary employment they're trying to ban. And at the end of the day, after a lot of negotiation and I think greater realisation, no such thing happened. The legislation was passed at the beginning of this year, and it in no way bans labour broking. It regulates the industry, which suits us down to the ground, because you get a much better definition of what is and what is not possible in the industry. We have focused and structured on what is possible and come up with solutions, and the net result is that maybe on the perimeter of our business there would be some people that we could not employ because they would become permanent employees. But outside of the perimeter on the main core business, we're finding that since the legislation became implemented in April of this year, that our turnovers in fact are going up because there's competition who have not been able to react as we have, probably because of size and the way they operated before. So it's given an opportunity for us to get business elsewhere. And second of all, there's been a pent-up demand which hasn't been satisfied, because people were nervous for the 4 years of increasing their exposure to labour broking, and now there is the element that you can do it. When this legislation came in, and I think this becomes core to our strategy, when it was started to be mooted, we looked at our business and said, well, if it does happen, and they do ban the labour broker, then we haven't got a business. So what are the strategies that we can adopt to really to ring fence that and find other sources of revenue? So what we did is we looked at the support setups that we had already developed within our business to support our business, and decided to turn those into fully fledged subsidiaries which, and businesses which would be able to operate independently of our business and would no longer only serve our business but would serve people outside of the areas where we have contracts. And the resultant strategies were that it started our financial services division, which is the Barbareki division, which showed you there, and the essential employee benefits. In essence, what that was doing pre the strategy was helping our workers fund their paychecks, because in the days when you got paychecks, the worker would get the paycheck, he didn't have a bank account, he would go to the nearest money lender and get half of what his earnings were. So we created a lending facility that enabled that, helped that. So we were able to expand on that, and today Barbareki is a very fully fledged business doing micro-lending, mainly to our employee base, but it also does sale of products such as cell phones, laptops, TVs, and it also does, also in conjunction with that, we've got a business called Employee Essential Benefits. In terms of the legislation that has been enacted, any worker has to receive equal pay and equal benefits to somebody who is permanently employed, and within the permanent employment field, you have to receive equal pay and equal benefits to somebody who's already employed in that field. So it applies to a person's permanent place. We established an employment benefit model which enables both our clients and non-clients to give benefits to all of their employees. And the uptake on this has been very strong. The benefits are funeral benefits, it's unemployment, it's disability benefits, life insurance, extends to its family, medical. So it gives a whole range of benefits which an employee can get, and we've had the buy-in from several very large companies, and this is rolling out, and it's going to become a very material part of our business. We also took our training business. We had a lot of small training areas. We centralized it under a management team, and today we have a major focus on the training, mainly in the blue-collar space. We also do a lot of learnerships. We do internships, and we also do a lot of training of disabled workers, and generally the training division of our company. We run it through 9 branches at the moment. We started off with 2. We lop it into our 60 branches that we've got, so there's plenty of room for expansion on it, and training is, to us, something of the future. There's a huge need for the training of technical and blue-collar workers, because there isn't that much available. And when you'll see our other policy of exploring into Africa is there, the training model that we have here exports beautifully into Africa, because they are in the same need, if not in greater need, of training. And this training is basically government funded or company funded. We haven't ventured yet into the private training, the private individual at his cost, but that is part of our plan in the future. We have a medical division called, as I mentioned, the medical division. What it does is wellness. It does, we have about 75 clinics situated at our clients where we do entrance and exit medicals on a continuous basis. And generally speaking, we look after and care for the workers' well-being and enable our clients to report on that to the various government bodies as they have to. We enable that as well as managing the medical healthcare division. It is also an area which we believe has very strong growth potential. The other strategies that we have, and I'm going to be a bit quick because others also need to talk, is our nursing division, which is above the threshold. The earnings are above the threshold and are not affected by the new legislation. Our Africa strategy, where we have employed a team of people to develop our businesses. So far we've started in Mozambique, Botswana, Namibia, and we're doing a bit of business in Ghana. We believe that in the future there's a lot of opportunity there to do a cross-skill sell between South Africa and these places. The other thing is our clients are moving into Africa, all the big clients are moving into Africa, and for them it is more comfortable to go with somebody that they've been dealing with in the past and has a certain set standard. So we're finding that we can follow our client into Africa to generate business. We have process outsourcing, which I've mentioned before, which runs by unit value. At the moment, our company is doing the process outsourcing for ArcelorMittal. We do all of their deliveries of everything that they manufacture at any of their plants, other than Saldanha, which we hope to corner within the next week. We make candles for Sasol on the basis of output. We manufacture for CHEP, the pallet manufacturing. We do all of their pallets, all on an outsourced process basis, so much per pallet. The management of it is ours. The way that we incentivize the worker is ours. So that is a whole new stream of business. Parallel to all of this has been our IT and systems development. You know, to manage 30-odd thousand people on a payroll every week requires quite an extensive management payroll system and reporting system. And this has been developed over the years and keeps on getting more and more sophisticated. Today we have the objective of having biometric clockings at every single client. We've got about 3,500 clients, so that seamlessly the times that are clocked automatically come into a central processing system, and there's no finger capturing, there's a great deal of efficiency and speed. So the midnights of capturing times we think are going to disappear. You'll see in our figures that IT is a big asset that we have, and the one thing that we haven't done as yet, it's something on the future plans, is marketed our IT systems because they are very usable within the market and they're quite unique. We've also, at the same time as doing all of this, naturally had to build up a very strong management structure and succession structure. I hope not to be here in 20 years' time, but maybe I have to, I don't know. No, we've built up a strong management structure. Each of our divisions is fully managed with its independent management, reporting into our executive team. They each have their own executive team and very much are masters of their own destiny within the certain parameters that we set as a corporate, as a head office corporate. In the recent year, in the last year, we formed a mergers and acquisitions department because we feel that our company is at the right stage to embark on a number of acquisitions. We've looked at a number. Craig Katz is sitting here, was employed to head up that department. We have a cautionary at the moment on one transaction, which we hope to finalize very shortly. We have a very strong pipeline of acquisition possibilities. All of our acquisitions are directed at our existing businesses to beef them up. We're not looking at this stage in any event, we're not looking at acquisitions of things that we're not familiar with. They have to be businesses such as in the training business, or in the medical care business, or in the staffing business. Those are the areas that we're looking to bulk. So far, growth has always been organic. We've had a couple of lock-on acquisitions, such as the FemPower, the Tele-Resources, and nursing emergencies. They've all fitted very well within, and we feel that we know how to manage them. We also developed, as I said right in the beginning, a policy of becoming more investor-friendly. We want the investors to know what's happening in our business. We want them to be able to criticize what we do, but also to support the positive steps that we have. We are all, within the business, we're all extremely positive. It's a great vibe. You think that everybody's on caffeine the whole day. Our business has a very positive vibe, and the people that work within it are all very positive. Having said that, I now have to give you over to the financial director for the financial. Willie, you'll take that.
Okay, so the message we really want to convey today is to just pick up what's our take home out of this 6 months results. So we start in saying we believe we've got a sustainable organisation, all about diversification, all about we set up a platform to grow our business, and then our cash generation the last 6 months we particularly happy with. And then we just briefly talk about our cost-cutting exercise we've embarked on the last few months and how that's panning out. And then I also just want to touch briefly on the acquisition side, the strategy around that, and then what our focus areas are at the moment or for the next 6 months. Okay, financial highlights. So we'll talk about all of these a bit later. Revenue up 4%. We have it on our highlights. It's not the kind of revenue we used to. We've been growing at rates of 12, 13, 14% per year now for many, many years. So there has been a bit of a slowdown, but we'll talk about that. Diluted earnings per share up 11.6 cents. Net asset value, that's a 12-month view, up 22% to 127. Earnings per share, headline earnings per share up 27%. Cash conversion ratio, as I mentioned, 96%. Days outstanding improved to 44 days. It was 49 12 months ago. It was a little bit better in December, 42 days. Income statement. I've got my relative slide, the following one. Just on this one, noting our second 6 months tend to be much, much better than our first 6 months. Last year, not so much. But it typically tends to be better. And then also worth noting on the slide is your finance cost came down nicely. That also talks about a reduction in our debt situation. And then we've got a taxation credit. So the taxation credit is a result of our, number one, our employment tax incentive, and then number two, our learnership program. So our learnership program, we spend a lot of resources on it to make it happen, and at the end of the day we get our 12, I think it's 12, section 12H benefit from that, and that gives us then our deferred tax asset, which I'll talk to when we get to our balance sheet. So that's effectively why we've got this tax credit. We believe it is part of what we do, and we believe it will continue in the foreseeable future. Okay, then we get to the meat of the group financial highlights. Revenue is up 4%, as I said. Some of it, so it has to do with the Labour Relations Act. When it came in, and we think it had a bit of a negative impact on revenue growth. It did. We believe it's temporary nature. There are signs that the market's picking up again. And also then we had a bit of a timing difference in that some of our solar project business, the projects came to an end and some started up, so there was a little bit of a gap, and that's starting to pick up quite nicely as well. So if it's not normalized, if you want to normalize for that, it was more or less a 6% revenue increase. Gross profit percentage went up from 20 to 23%. It's to do with, there was a little bit of a mix difference. Recruitment business, which is our high margin business, picked up quite nicely. That was the solar business, again at the lower, it's got a higher margin, so less of that turnover, so that pulled it down again. And then the employment tax incentive contribution increased for the 6 months, so that brought it up again. So 22-23%, it's still pretty much there, nothing materially different in the business. Okay, EBITDA only up 1%, so that speaks to your operating expenses line. Operating expenses are up 10%. So the 10% is mostly due to we've bulked up on our healthcare business. We've bulked up. We've employed some very talented people to drive our African division, and we also mergers acquisitions. So we believe we'll get a return on that investment. That talks to our cost-cutting exercise. We've been able to take out substantial cost in our business in the last month or two. The results of that you'll only see in the second 6 months. Okay, profit before tax up 6%. Incidentally, this is your from continuing operations. We added a little bit of a small discontinued number. You'll see it in our full income statements. And that again talks to the interest line that came down, that started to come down. Our balance sheet, asset side of it, just want to highlight a few items. Your intangible assets, that's our IT infrastructure that Mr. Katz talks about. We do most of the developments ourselves. We believe we're much more efficient with it that way. It's much more focused IT systems that's applicable to our business. We write it off over 3 years, so we believe we've got much more value unlocked in that. Then we've got a deferred tax asset, 37 million rand. So the big question was always, can one utilize that deferred tax asset? And yes, all indications are we will be able to utilize that going forward, which stands us in good stead as far as our cash situation is concerned, because we effectively then don't pay tax on our earnings. And then obviously driving this, we're still continuing to do more learnerships, which then drives that line. And then, yeah, our trade and other receivables is our biggest asset. And then just note how consistent it's been over the last 3 reporting periods. It stayed quite consistent. And, yeah, and I think that talks to good management. On our equity and liability side, if you can just look at the financial liabilities line, also came down quite nicely. And then our cash flow, the key number there is reduction in net borrowings. Our borrowings came down with 21 million rand, which is quite pleasing, giving us a 96% cash conversion ratio. Key ratios and targets. So our target on net profits to sale is 4%. We ended up 3%, still some work left there. Operating expenses to sales, almost 19% to 17%. So that also talks about cost-cutting initiatives. Annual return on equity, not quite at 20%. We believe our weighted average cost of capital is around 17%, so 20% is a good number. Cash conversion ratio came out very, very nicely. And our days sales outstanding is also also not quite where we want it to be, but it's increased, it's quite improved from previous years. Okay, then talk about our acquisition strategy. Mr. Catch mentioned as well. It's a key strategy. Like we said, we appointed a mergers and acquisition specialist, a very talented guy. So we're expecting a lot from that. And just to say, the message is, so we're serious in that space. We are on acquisition trail. We've done our cautionary, and we're doing that now. What's our objectives? Always needs to be cash generative. We want to unlock further synergies in our business. So obviously, if you do acquisition in the same space that you already are, there are some synergies to unlock in terms of know-how, in terms of cost, in terms of all sorts of synergies. Diversification to the extent that we buy outside of our core business, but we buy in our core business as well. We're looking at in that space at that well. And then we want to enhance our existing portfolio. We want to put the portfolio on the table that makes sense, that is accretive, and that generates cash, and that mitigates your risk in our business. How do we fund this? In our space, it's common practice. We do it a big part of the acquisition is done on an earn-out basis. Why? What are we really buying? We're really buying the goodwill of the sellers. And it's equity. We can do an acquisition of maybe 2 rand, maybe 3 rand, you know. So there's a substantial gearing effect of it. So we're very excited about it. And then we utilize cash and shares, a mixture of it, depending on how the negotiations go. And then we also have a facility with our bank where we fund our debtors book. So we can effectively, most of the time, we can fund 80% of the equity we buy in the business. And obviously the goodwill, the biggest part of the goodwill can then be earned out on an earn-out basis. Not saying we will be able to do that all the time, but that's certainly the aim, and it's certainly doable. And then going, so we're looking at a lot of acquisitions at the moment. Okay, and then in terms of financial prospects, what we're focusing on, like we said, cash generation. We've got a big focus on cash at the moment in the business. Inculcating it through the business, managers focused on cash. Business development and diversification. So there, like I said, our staffing, our recruitment business picked up quite nicely. Very strong in comparative previous years. We expect that to continue. On the core side, the core staffing side, after the Labour Relations Act implementation, we see the market opening up again. It's still early days. We'll see how that runs. And then, the solar project, which is quite a substantial part of our business, is running at full steam at the moment again, after a bit of a slump, as we said, for 6 months. And then our cost cutting, like I said, we have been able to take out a substantial cost of the business. It's still ongoing process. Obviously, the further you go, the harder it gets to take cost out of the business. A lot of that is technology driven as well. And yeah, as I said, the acquisition side, that's still a key part of our focus of what we do at the moment. And yeah, that's it for the finance part. So then I'll hand you over to my CEO, Lawrence Diamond.
So I think there's one message that I'd like to get across outside of just the operational review, is that our business perception, a lot of perception in the market is our business is predominantly an industrial staffing business. Yes, it's a core focus of us. Yes, we will continue to grow that segment of the business. However, we provide a lot more of a holistic solution to our clients, and it's on that foundation that we look to grow going forward, like Willie was saying, re-acquisitions, etc. Our services, we believe, benefit labour markets, contrary to what a lot of our stakeholders say. We believe we are a substantial contributor to economic enablement within South Africa via job creation, youth employment. Individuals that we put onto sites, we manage, we believe that we provide them with opportunities, legally compliant opportunities to work, facilitate training and skills development, wellness opportunities, and a range of benefits. This is a market that we understand, and we believe that there's a substantial gap in this market to grow these solutions. Our clients are obviously core to us, and we see ourselves as thought leaders in the space. We understand labour, we understand the challenges that come with labour, but we also understand the solutions. So whether it's advice we're giving our clients in respect of current labour legislation, and whether it's us actually implementing solutions for them, we're confident that we're able to provide them with solutions that can assist their businesses in growing. Our capability is expanded upon in terms of our reach. I think we've touched on this already. We're very representative already within South Africa through 60-odd branches. Our growth strategy into Africa is starting to materialize. When I say our growth strategy, we've taken a view that Africa is a risky place, so it's a follow me strategy. We work with a lot of clients in South Africa, and as they invest in different areas in Africa, so we go with them. To date, we have physical operations in Mozambique, that's in Maputo and Tet, in Botswana and Namibia, and through a partnership in Ghana. So the team that Willie was talking about is a substantial Africa team, and we see the scalability of our business model enabled by technology, allowing us to move into new markets relatively quickly. Just in terms of our client base, plus minus 3,500 clients. I think it's also very important that there's very little concentration risk in our business. Our clients range from corporates all the way down to SMEs, and the segmentation is across industry. We deal with manufacturing businesses, wholesale and retail, mining and quarrying. Willie touched on a little bit of the renewable energy space, and our exposure within that space is not necessarily only to blue-collar staffing. Our exposure in that space is across the skills matrix, whether we're supplying blue-collar, industrial staff, all the way through to artisan-type capability, and then through our specialist staffing divisions, obviously white-collar specialist capability. I think the message there is a substantial client base, little concentration risk, and a lot of exposure to different industries, which is great for us. In terms of a 6-month review, Willie's gone through the numbers. I think from an operational highlights point of view, we touched on the fact that revenue wasn't at our normal 13 to 15%, 4%. I think a focus for us as management over the last 8 months has definitely been bedding down the current labour legislation. There's a substantial challenge. We had to engage with 3,500 clients and 35,000 odd assignees with new contracts, and so a lot of our management time, etc., went into that space. But I think it was good time, it was solid time invested. in the sense that on a whole, we've been able to maintain our current client base. So we think we've protected our current market share within the most vulnerable segments, given the legislation. And it gives us the ability to now move into a growth stage of our business and actually start expanding market share. Our specialist recruitment brands, which I'll touch on a little bit later, Mr. Katz also touched on it, we're seeing strong growth in that segment, very solid order books, lots of send-outs, and across that segment of business we saw increases in profitability. Another substantial highlight for us and a fantastic diversification also being touched on is the launch of our EEB solution. I'll touch on that in a little bit more detail later. Cost consolidation is critical. We're at a point in the business where we're saying that our systems are at a stage where we're able to create the concept of a shared services model throughout the group. So Vili's touched on it. We're very involved in consolidating costs enabled by systems with a view to providing solutions to the market but becoming more efficient internally as well. I think the benefits associated with that we'll probably see in the next two reporting periods. Our BE level still at level 3. We understand that the codes have changed and we'll be rating on new codes like everyone else next year. We have a strategy in place and it is our objective to remain in that segment. I think training also is a core focus for us. We've managed to be very successful in being awarded substantial learnership contracts and internship contracts, building a capability, a diverse capability in training and giving us the ability to grow on that. And youth job creation, the concept around employment creation and the employment tax incentive, absolutely as part of our business, it's intrinsic to what we do. It's a focus for us. We believe that whatever incentives are applied and by government, we will utilize learnerships, internships, ETI. It's part of our business and we're very well positioned to utilize these incentives and grow on these incentives as they come available. Revenue segmentation shows the diversification coming through. I think what it does show also is that it's still relatively small from a turnover point of view. The staffing and recruitment segment is made up of the industrial staffing side and obviously the white-collar specialist recruitment side. I think we've touched on it, how we make our money in that space in terms of ongoing annuity fees, industrial staffing side, and permanent placement fees. The message there again is the market and who we deal with is not specifically only blue-collar. We have a very broad range of capability. I think just to then touch on the whole TESS marketplace, there's been a lot of press around the labour legislation. And I think it's critical that we contextualise this to potential investors and stakeholders. TESS in the global market space is a growing requirement. It's something, the world of work, when you look at the research, the world of work is changing. More and more people, funnily enough, are tending towards flexible nature of work than permanent. It gives them the ability to learn more, gives them the ability to experience more, and on the client side, it gives them the ability to control their costs, to variabilize their costs. So there's a substantial growing trend in TESS and flexibility everywhere in the world. These are some of the statistics that we talk about. How does that mimic the South African marketplace? It's quite an interesting slide that I picked up from a piece of research that was done at the University of Cape Town. See the black line there really talks about TESS employment as a percentage of total employment, and as it's tracked from 1996 to 2014, you can see the increasing trend of outsourcing in the market. It's gone from 2.2% to 6.4% of the same period of total employment. The other interesting thing is over the years 2012 and 2014, that's typically the period where the new legislation actually started being promulgated. And there was a lot of discussion and debate. Even though the trend was not that steep, it was still growing. What we have seen is the market, a market that's growing, requirements for companies to variabilize their costs, to manage productivity better. What we have also seen in the TESS space as a result of legislation is a consolidation in the marketplace. How has it assisted us? Barriers to entry have increased, and as a result, the smaller player is having difficulty. That represents opportunity to us. The legislative landscape, I'm not going to go into this in a lot of detail, it's a subject on its own, but really we talk about the Labour Relations Amendment Act, and we talk about the New Employment Equity Act. The main challenges specific in those two areas is something which I'm not sure if you've all heard of, the deeming provision and the equal pay for equal work job classification. Our view on the deeming provision talks about 3 months plus 1 day. At just past 3 months, the employee can be deemed to be employed by our client. Subsection of the Act, which is a 198B, talks about fixed term contracts, and it talks about should there be justifiable reason, okay? As long as there's justifiable reason, then there's no reason why employees cannot be engaged on a fixed term contract. So everything from 0 to 3 months is ad hoc. It's catered for in the Act, and it's a massive part of our business, talking about retail ad hoc, stock takes, etc. Anything post 3 months, as long as there's a justifiable reason. The classic example is a construction company building a soccer stadium, and the typical duration to build a soccer stadium is 2 years. This is a project. So there's a justifiable reason for the project. There's certain skills that are required on that project over a period of time, and the Act allows for the employment of those individuals on a fixed term contract. So the perception in the market that TES cannot apply and cannot grow, I think, is a very incorrect perception. If anything, we believe, we're very proud of our TES business. We believe that it will grow. And why? Barriers to entry have increased. In order to enable these solutions here, you need to have technology, you need to have systems, you need to have investments in IR departments and legal departments. So typically what we've said is that this legislation in the medium term, we believe, will favour the bigger players like ourselves. An interesting statistic, the TES market makes up approximately 600,000 jobs a day in South Africa. Of that 600,000 jobs, only 8% of that market share is managed by the top 3 suppliers. So it gives you an indication of the level of fragmentation in the market. We have 34,000 of those people. It gives you a level of the fragmentation of the market. More importantly, what it shows me is the level of opportunity still to grow, even if that market shrinks slightly as a result of permitization in respect to the legislation. Our specialist recruitment business, channeled through various brands. We've touched on it: FemPower, Only the Best, Teleresources, Acotech. These are all performing very well. We've had substantial wins, contract wins, specifically in the medical staffing space. We awarded a contract relatively recently by the Department of Health, funnily enough, contract worth 40 odd million rand, and more recently a contract by Life Healthcare, which should see this business growing even more. The business process outsourcing market, which is serviced by our brands, Teleresources, very focused in the telco space and the collection space. Also, we're seeing increasing headcounts coming out of that. We've seen a lot of rationalisation in the telco space, the MTNs, the telecoms, going through substantial retrenchment processes. They still require that capability. And that's where a business like ours fits in. We're able to variabilise that cost for the client, but yet to still deliver on the same service levels that they require. The specialist recruitment segment of the business, the white-collar segment of the business, I call it counter-legislation. What I mean by that, Mr. Katz touched on it, the earnings threshold will typically fall above the threshold, which takes it out of the legislation. So this entire component of the business is not affected by the current legislation. I think a big part of our business and a big part of our growth is coming out of our training and consulting division, Training Force. The business, again, I'm not going to go into the history, we've touched on it, which we started to develop internally a few years ago as a result of the SDL, Skills Development Levy. We've now commercialised that business, got a fantastic management team in it. We've been able to prove our capability. We received discretionary grants from the CETAs this year so far. That includes close on 1,000 unemployed call centre learnerships that we're currently rolling out, 100 unemployed bricklaying apprenticeships, 230 manufacturing learnerships. We're also hosting internally and at our clients close on 400 internships at present. Another project that we're very, very proud of is also a partnership, funny enough, also with government, specifically in a rural area just outside Klerksdorp. It's called the CESTA project. We partnered with them, development of the training capability in bricklaying, and we've trade tested almost 70 bricklayers in that space. I think what I'm trying to put through here is we see training as a huge opportunity. Skills development is becoming even more important within the South African context, aligned to job creation. The new BEE codes assign close on 25 points skills development. I think 25% of the scorecard is aligned to skills development. Companies are going to be required to contribute close to, at least spend close to 6% of their leviable amount on skills development going forward. As we touched on it, it's a very interesting space from this. It's a space that we're going to look to grow in substantially from an organic and acquisitive point of view. Which one? Financial and lifestyle products. We have three major segments there. We have Babareki, we have EEB, and Dreams Direct. I'm going to touch on EEB. I think it's a fantastic milestone of us. Employment Equity Act talks to the provision of equal or similar benefits to various levels of staff. We saw a substantial gap in this within our current business and within our client's business. So we established EEB. What effectively is it? It offers boutique benefits, very specific to the user and the industry, to low-income earners. We classify low-income earners under 15,000 Rand, and incorporates products such as funeral, accidental death, income protection, medical benefits, and wellness offerings. This has been structured, this entity, utilizing internal and external cell captive that gives us the ability to be innovative and innovate and develop our own products. And more importantly, it gives us a substantial price advantage. Another interesting thing that EEB has done is, in partnership with First National Bank, has put together a banking product and a lifestyle benefit product, which we're taking to market right now. And we've had substantial uptake of that within our own base and within our client base. Currently, 24,000, call them belly buttons, 24,000 belly buttons are secured under various covers that EEB offers. And that's within the internal base, but more importantly, we're selling the solution externally to our clients' permanent employees. Big opportunity for us, and we're very excited about the opportunity. Employee health management, also is an interesting business for us. We've invested, Billy touched on it from an operating spend point of view in the last 6 months. We see this business growing. Material wins in contracts recently, RCL Foods Limited, in the process of rolling out 13 clinics nationally to close on 9,000 employees within the construction industry, WBHO and Avenge, deployments of clinics, mobile clinics, 2 sites, conducting quite a few medicals every single month. We're seeing an increasing need to service the medically uninsured in an efficient manner. We need to be able to provide mobile capability to get to these people, and it's been driven by compliance, occupational health and safety, critical, and employers requiring to enhance the employee value proposition. So health management as well for us, key part of our solution going forward and a key part of our focus. Process outsourcing, Mr. Katz touched on it. It's an advanced, if you want to call it, I like looking at it as, outsourcing comes in different stages of maturity. You've got your basic labor outsourcing on the one side of the scale, and as you mature through the process and through risk, you're through to management outsourcing all the way through to process outsourcing. What effectively we take ownership and control of a process that our client has. We spoke about ArcelorMittal, tough industry right now. We understand the challenges that it has, but what is our role and function within ArcelorMittal? The finishing and dispatch capability of ArcelorMittal is managed by us. So we manage that entire process. The people are ours. Okay? We apply the people, we apply the input cost, and we manage the output. There are certain thresholds, there are certain performance bonuses that we get paid should we achieve those thresholds for Arcelor, and it's a win-win, because ArcelorMittal wins from a productivity point of view. We win in terms of there's flaws that we can't lose too much. There's flaws, but there's obviously the opportunity for performance bonus on our side, and very importantly, the actual assignee is able to take his wage and better it from an incentive point of view. This is a critical model that we're exploring with all of our clients across South Africa. Concept of productivity. How can you take a straight test outsource, labor broking outsource, and mature it to a productivity-based outsource? We're seeing in a lot of our clients hybrid solutions, some tests, okay, and some productivity process outsourcing, and those sorts of mixtures provide the value to our clients. So PPO, program process outsourcing, also very interesting for us. It's a value proposition that we're offering our clients, and it's very interesting to see that our clients are understanding it and seem to be adopting it more and more. Mr. Katz spoke about some of the case studies there. Their pipelines are looking also quite strong, and be interesting to see how that delivers. DebtWorks Collection Agency really came about because we needed to develop a capability around our current lending business, Barbareki. So we needed to ensure that we collected our own debt for Barbareki. In that process, we had to deliver capability systems. It needed to be a separate entity, obviously. This is a business which, of late, the last 6-12 months, is really starting to do well, not only in collecting our own debt, but also collecting external debt. We've been successful in securing books from a couple of other clients, and we're starting to collect some of their book. It's a process outsource. We manage the collection process, again enabled by some clever technology. Workforce Africa, gee whiz, it's we look at ourselves on the map, and then you look at Africa, and everyone says, look, let's go into Africa, and then you jump into Mozambique, and Mozambique's look this small on the map, and it's got its own rules and regulations and challenges, etc. So Workforce Africa is absolutely huge. I think the amazing thing for us is our ability to apply our business model in Africa is there. The scalability of our model, whether you're talking about staffing, whether you're talking about training, whether you're talking about employee benefits, the same challenges that we have here, they have there. And the ability for us to mobilize projects, what I mean by that, where you put up a solar farm, the Spanish arrive in the Northern Cape, they have no idea and no understanding of the labour legislation, the skills requirement, etc. Our ability to move into a place like Pofadder, literally overnight, and establish a recruitment centre, and establish housing, and establish transport, and establish feeding capability. That's what we do well. This is a core capability of ours. And that core capability is scalable. It's not something specific to South Africa. It's something that the entire continent of Africa needs, and not only Africa. If you look at some of the major competitors of ours internationally, the likes of Adecco's and Randstads, these are businesses that do exactly what we do on an international scale. So we're very excited about Africa. I've touched on Mozambique, Lesotho, Tet, Botswana, Ghana. We're currently doing some training in Ghana through Training Force. Tet, we're busy sending paramedics to Tet, to the various mines there. It's a critical requirement for safety on the mines and skills. Where do we source those from? Funny enough, we're sourcing from South Africa, and we're also sourcing from the East. So our business is not only about South African skills, our business is about worldwide skills. People are moving today, and our ability to manage that movement of people is inherent in our business model. Risk mitigation, I think some of our key risks, we touch on client perception of the LRA. It's dangerous. There's a lot of press around the LRA. Typically the press around the LRA has been negative, labour brokers can't exist, we can't do our business, etc., etc., etc. We need to manage that. How do we manage that? Through a process of education. We're looking to become more visible within the market as far as our solution is concerned, and as far as our value proposition is concerned. Technology, it's a risk. It comes with its opportunities. Critical for us is, as we grow our business, is to ensure our technology is up to speed, ensure that we can integrate our various business units, that it gives us the opportunity to cross-sell and take advantage of all the cross-sell opportunities that exist. Agility is also very important. We started noticing 12, 18 months ago that our fixed overhead base within our own business needed to become a little bit more agile. We need to be able to, very similar to what we engage with our clients, we need to be able to variabilize components of our overhead base. So we need to ensure that our business model and our structure is agile so that we are able to implement change quicker. Strategy implementation, I think our strategy of growth is in place. At the end of the day, it's very, very focused on and enabled by people. So our talent acquisition strategy is linked to our overall strategy. And Mr. Katz touched on it. We've got some great people in this organisation. The organisation is managed on a decentralised basis. The guys are passionate about their businesses, they own their businesses, and they only want to see their businesses grow. At the same time, saying that, we have to onboard new talent the whole time to enable our strategy. This is something which we currently implementing. liquidity to fund business growth. Obviously, cash is king. To enable our strategy, we need to ensure that our cash conversion ratios stay where they are, our DSOs are reducing. We need to ensure that our funding relationships are in place. And I think where we are at the moment, as Willie discussed, is we've made huge progress in that space. And with the ongoing growth of the business, I think that funding capability, be it from shareholders or through debt, I believe will assist us in growing. Prospects, our strategy of growth and diversification, we're excited about our business. We're excited about our test business. We are excited about our labour broking business. Our labour broking business is going to grow. We're already seeing it. Buyer behaviour is changing. They're not interested in dealing with the moms and pop shops anymore. They want to deal with the compliant provider. So we're seeing more and more of the buyers that used to go out and purchase their labour on an ad hoc basis out of the shop floor, formalise their procurement process in tenders, and typically who wins those tenders? The bigger players in the market. So we're excited about our labour broking business. We think we're going to do well. We think the legislation medium term is going to assist us. Our further growth and diversifications in terms of our other businesses I've touched on: training, healthcare, employee benefits, acquisition opportunities. I'm not going to go into that, but he's taken you through the acquisition strategy. We're currently under cautionary, and our pipeline on acquisitions is definitely looking strong. Africa, I've touched on as well. Management of costs and implementation of the shared services model. I think the benefit associated with that, which we've already implemented, we'll start seeing in the next reporting period, and obviously that will have an impact on operational efficiency. So we really believe that although the business is 40 years old, it's unbelievable the level of experience that's been developed over the last 40 years. We believe that we're at the point where we can really start capitalizing on that growth trajectory, and gives us the ability to capture more opportunity and greater commercial value, and hopefully in that process generate a lot of shareholder value. And I think that's it. So thank you very much for your time.